Let's don't waste time and get straight into the video. So here are going to be all of the rules when trading my strategy. Now it's 4 different ones, but in reality it's really just 3. Because the first one is just set up your time to UTC standard time. It's very important, or else we're not going to trade the same time when you're going to do this on a live market. And it's super easy to do. Currently we are on TradingView. Just go to the bottom right of your screen, and as you can see you have this little icon in here. You're just going to press on it, and then from here you can select the time zone. Always select UTC. That's it. The next thing is going to be you have to know the daily bias, which basically is the previous day high or low. Where's the next draw on liquidity going to be, and also context. And keep in mind there's timestamps down below. So when identifying the daily bias, you basically just want to ask yourself, where am I coming from and where am I going? Now, simply as that, in this little bit of price action, as you can see, we are coming from a little bit of down movement. So all of this doesn't even matter as of right now, because we really only care about this sudden move onto the downside. So we came from this price action leg. Where are we going currently? We have gone for previous liquidity, and now the thing is, every time the liquidity has been taken out, we are having movement onto the upside. This is basically the fundamentals of the markets in that sense. When liquidity is being taken out, that is going to be fuel to go to the opposite side. So even in these cases, when you are trading onto the downside, since we have taken out liquidity, now is the time to go to the opposite direction. Notice how this entire price action week is also telling you that sellers were in control, and don't get me wrong, they still are in control if you're going to look at this massive candle onto the downside. But at that point in time, at least, buyers were getting in control again, and sellers were not able to keep the price right in there. So from here on, basically, the daily bias for the next candle is going to be bullish, and we are going to aim for the previous day high. Now, this specific approach is just using a daily time frame. I am going to get a little bit more advanced in just a bit. So we are going to go for the previous day high for that day. Notice how you don't even have to be right for the entire day. This entire candle was looking bearish at some point. You only have to know if we're going for the high or for the low. If you are able to predict if we're going for the high or for the low, then you are already good at predicting the daily bias. You don't have to know that, okay, in the morning we are going to go lower, then in the evening we are going to go higher again, and then the candle is going to close. No, don't try to predict 1, 2, 3, 4, 5, 6, 7 steps ahead. Only know previous day high, previous day low, that's it. So for this particular day, where are we going? For the previous day high or for the previous day low? This is where context comes a little bit into the play, and where it's getting a little bit more advanced on the daily time frame. Since we are sitting in this FEG right now, it's pretty unlikely that we are just going to go for the previous day high or for the previous day low. See, that's the thing. Not every single day is going to be predictable if we're going for the high or for the low. So on that day, even if we are going for the previous day high, and even if you would have said we're going for the previous day low, we're not going to trade this day entirely. So from here on, we're just going to skip the entire day and see what the next candle is going to suggest. Now, the dilemma in here that we had is that we traded into this FEG, and now we're trading away from it. So previously, I've also told you, you have to know where is the market coming from and where is it going. We're coming from this down movement. Currently, we are targeting lower liquidity. So this in here is basically weak liquidity. Now, why is that? Because we have traded into a fair value gap that is now basically pushing the price lower. So this is basically your real resistance level. People like to trade resistance levels as there is some magical level, but in reality they like to be traded into. FEGs can be the real support and resistance levels. Now, I'm also trading them differently, but we're going to get into that a little bit later. So from here, I really want to ask you, are we going for the previous day low or for the high? Now, there's something to keep in mind there, because right now we have 2 reasons to actually trade to the downside. Firstly, it is this candle already, which is just trading lower, but also if you're going to look closely, we have this candle low and also this candle low. If I'm now going to draw a line from left to right, this is going to be relative equal lows basically, because if I'm going to go on a lower time frame, you can see that these candle lows are relative equal lows basically. Now, the market loves to put liquidity under these kinds of lows. So now already you have built up a framework. Probably we are trading lower because you also have the context of going into this FEG first. And then from here on, the move is pretty obvious, isn't it? We are just going to go onto the downside. So notice we had basically 2 approaches so far. Number 1 was basically having only the daily bias. Number 2 was having the daily bias, but also combined with an FEG, so basically context. Now we're going to add another one. Sometimes you are just going into one direction, such as in here. 3 consecutive candles, lower and lower. Now the problem with these kinds of moves is just that the longer a trend continues into one direction, the more likely it becomes that it's just going to stop and go to the opposite direction. So in that case, we need something that is going to tell us, okay, now's the time that we're going to trade higher and we're not going to go lower anymore. This is where you have to look at the left basically. You need to look for swing lows that we have traded into. Now, and these are not just any swing lows, they have to be on a daily time frame, such as in this case. Since we have traded into that low, now's the time to look for a weakness. Remember guys, I'm not saying that from here on just long and that's it. Just look for a weakness if the chart is telling you that we're trading onto the upside. So I'm going to skip onto the next candle. This candle has not shown you weakness. There's a specific reason for that. Because the candle closure was basically below this entire liquidity rate. So that's why the momentum going lower is still there. So now we have taken out even more liquidity, right? And you're going to continue this until enough liquidity has been taken out. But pay attention to this little wick. It's basically the same what we had in here, but this candle was a bullish candle and this one is a bearish candle. The wicks are always telling you a story, guys. In that case, the candle is starting to show weakness. Buyers are starting to get in control now. Don't get me wrong, it doesn't mean that we're just going to trade onto the upside for this FEG or whatever, but it's an indication. So from here, we're just going to patiently wait for the next candle. The next candle has also gone for the previous day low, as you can see. But once again, it is starting to show weakness. Pay attention to the candles. And this is basically the exact candle that you want to see. You had your movement lower, you traded into a PD array, such as this liquidity rate, and then it has also shown you weakness. Now it's showing you willingness, right? It has previously shown you, okay, we are starting to be exhausted, the car is not running anymore, and we don't want to go onto the downside no more. So now it's time to go to the upside. So in this is basically the same scenario which we had previously with the relative equal lows, if you remember, but in the opposite direction. So we are trading higher. Now is the time to go for the previous day high, but also for this liquidity that is right in here. Because once again, if we are going to go on a lower time frame, then these two candles are going to be relative equal highs. Once again, two swing highs being relatively equal close to each other. But there is one more thing. This entire FEG is also there. FEG is likely to be traded back into. Now, if an FEG is just staying up like that, most of the times it is going to get traded into, and then from there, we don't even care what is going to happen because we really only care about the daily bias. So that also means that we are going to trade into the FEG. Notice how in the previous example, when we were in this little bit of price action with the daily FEG, we were in that FEG and then we wanted to trade lower and had the distribution. This is a little bit of a different scenario that we're having right now onto the time frame. Because in here, we are trading into the FEG and it has not been filled yet. So that's the key difference on why the daily bias is simply going to go onto the upside, such as in here. Now, in the case where you might be saying, well, but this was not looking so bullish. I've told you previously, you really only care about the previous day high, because most of the times, this is also going to determine your take profit. So, and I hope that by now it should be obvious enough. Where are we going? To the previous day high or for the previous day low? Once again, quickly, because with liquidity in here, probably low. We are also having strong movement to the downside, so once again, probably the low, not for the high. Now, there's something very special about this candle though, and we are going to get into that very shortly. This entire candle has no wick onto the upside. Usually, every single candle has a wick onto the up or downside. If that doesn't happen, then that candle is going to get rebalanced at some point or the other. But since the bias is bearish and we are having that movement onto the downside, we're just going to trade lower, simple as that. And as you can see, we have actually traded into the previous day low, not for the high. So here we are at the liquidity section of the video. Now basically there's going to be two different liquidity points that I like to look out for. And basically it's going to be the relative equal X, so a relative equal high or relative equal low. It's created when you have two swing highs being relatively equal close to each other. That's going to result in a lot of traders putting their stop losses above these highs and lows. The next thing is going to be FEGs. Now I might be saying, how is an FEG liquidity? That's what most people don't understand when trading this way. Liquidity is basically an imbalance, which also means that FEGs are basically the definition of imbalances, if you want it like that. Price was not able to have enough orders or enough liquidity in that specific price point, resulting in a fair value gap. So which also means that the price needs to rebalance those liquidity points sooner or later. Now, it doesn't mean that it has to be completely rebalanced, but you need to have at least a little bit of movement going into these imbalances, because this is the golden rule of liquidity. Take that into your notes and liquidity will become much easier. Every imbalance must be rebalanced. Simple as that. But there's a little bit more to FEGs than just trading them. Now, marking out FEGs is a pretty easy thing on its own, right? You have one in here. But FEG size matters, because basically we have just learned that FEGs are imbalances. Now the bigger the FEG, the bigger the imbalance is going to be, such as in this case. Now, whether or not something is big or small is going to depend on context. So if we are going to pay attention, we have an FEG in here. That FEG is way larger than, let's just say, this FEG, which has also recently happened. So you're only going to know when an FEG is large when you're going to compare it to the rest of the price action which has recently happened. So in that case, the FEG is quite high. What is that telling us? If the price is going to trade into that FEG, such as in here, we've barely traded into it, and that means that basically all of this, so below the liquidity rate in here, there is still a lot of liquidity residing, and price needs to go there at one point or the other. So which also means that rarely we are just going to keep big FEGs like that open. We are going to trade into them and then fully rebalance them, and then up until this point you can shoot for previous liquidity that is in higher. And that is basically what is going to happen. Now, price gaps are going to be a whole different story in itself. They are very similar to FEGs, but they are significantly not the same. Because an FEG, while although it is not subjective, an FEG is an FEG, a price gap shows you actually there was not enough liquidity. So this is not an imbalance, but this is more like a void. Imagine that there was not enough liquidity, so not enough buyers, not enough sellers to sustain that price action move. Now the thing about those is that most people like to trade into them, and a lot of other traders would now suggest that, okay, we have taken out liquidity in here, now we are going to go onto the upside for, let's just say, these FEGs, and this entire price action gap does not hold any weight anymore, but it's completely wrong in reality. The reason for that is, as long as the entire price action gap has not been filled with a body closure, so the entire candle has to look something like this and close below the gap low, only from that point on I am going to check mark this entire price action gap and not care about it anymore. As long as that hasn't happened, I like to trade into it. So in that case, it doesn't mean that we're just automatically going to trade onto the downside. Why? Because as previously discussed, this is a little bit more advanced. We have an FEG in here. If there's a large imbalance, price is going to go there. So if you're also going to combine that with a premium to discount range, you also know that we have not traded into an equilibrium. The equilibrium is basically 50% of the high and also the low. Price loves to trade back into the equilibrium because from that point on, the price action becomes efficient again, and from that point on you can trade into previous liquidity. Since that hasn't happened yet, the price needs to trade higher. And once again, from this point on, nobody really pays attention to the price action gap. Once again, it has not filled out with a body closure. So once we have taken out this entire FEG, we have rebalanced it. Notice how I'm not really caring about this FEG because this one is in a discount range. I really only care about the one that is in a premium. Everything that is above this line is in a premium. We have traded into it. Now is the time to go lower, because also this entire price action move in here is liquidity being taken one way or the other. If you're going to go into the lower time frames such as the 1 hour, the 50-minute or whatever, liquidity has been taken in this price action move. So from here we are going to go on to the downside. Liquidity has been taken, and here's going to be another mistake. Price traded back into it lower, and what can you see? I've just told it to you. The price action gaps need to be traded with a body closure. This has once again not happened in here, so we are still anticipating for the price to go lower. So in this point of time, we are just taking out liquidity from other people once again, because number one, they don't even care about that price action gap anymore. They have already removed it off their charts, and the one who still have it on their charts are definitely already out, because now they consider this entire price action gap to have no value anymore. But we're not doing like that. We know that this is a liquidity grab, and from here we are expecting lower prices, because once again the price gap has to be filled out with a body closure. And only up until this candle I start to not care about this price action gap, and from that point on I am going to remove it. Whether we go for previous liquidity is a different story. This was only for the price gaps now. And here's going to be a little bonus. Notice how this entire candle has no wick onto the upside, and the next candle has basically taken out its candle high because it needs to have a candle wick. I've told you that previously. Price likes to revisit those areas because it's just a rare occurrence, and there was once again not enough price action. Now, but this is also not random. This has also fallen back into an FEG, and then from here on you're just going to repeat the same story which we have just talked about. We have liquidity in here, relative equal lows, where we're going to go lower probably. And this is exactly what has happened. As previously mentioned, you want to ask yourself, where are we currently are and where are we currently going? Now we are going to the downside, no shit Sherlock. However, I chose this example specifically because it has a little bit of a dilemma. This entire candle has no wick onto the upside, but currently we are also trading lower. Notice how previously I've told you, if you are having a candle which has no wick onto the upside, probably you are going to revisit it at some point. Notice also how we have an entire gap in here, which we have not traded into with a body closure. So most likely we are also going to trade in there onto the upside. However, the entire order flow for that matter, if you're going to look at this entire price action, we are just trading lower. So where are we actually going to trade? We have 1,000 different reasons to trade onto the upside, but also another 1,000 to go to the downside. And this is the most important lesson that you're going to hear in this video, is not going to take a trade. And you probably expected like here's X, Y, Z on why you're going to take a trade, go to the downside or upside. But this is exactly the opposite. Don't take a trade in these kinds of conditions. So we're going to skip onto the next candle and see how that is going to look like. So we're going to let the entire daily candle finish, and here's going to be the opening. Once again, are we going for the high or for the low? We can't tell. We've already talked about that. So we're going to skip onto the next candle. So notice what is happening in here right now. I've already previously explained it to you. We are showing weakness. Notice how the entire candles are not looking as strong anymore, especially this candle right in here. Its body closure is pretty close to its opening, which is in here. So most likely we can expect to go onto the upside for previous liquidity such as this FEG. But notice this is not confirmation, this is just a clue on why we should go onto the upside. We are going to skip onto the next candle and see how that is going to look like. So as you can see, this entire candle is going to be our reversal. These entire candles were not able to sustain the price lower, and now we are just trading onto the upside. From here, you already have a very good framework. You want to ask yourself, are we going for the previous day high or for the previous day low? Probably for the high. And there's a couple of reasons for that. First of all, obviously we are having the established movement. This candle is trading higher because of its momentum. Secondly, we have this entire gap which we have also not traded into. The third one is going to be that we're having this entire fair value gap which we have also not traded back into. Now if we're going to look even closer and look at all of this, we have not traded into an equilibrium yet. If you're not trading into an equilibrium, that most likely means we are going to revisit it at some point or the other, especially because there's even more liquidity residing in here. So from that point on, we want to trade onto the upside. We are going to drop down onto the 4-hour time frame. So in just a bit, we were on the daily. Now it's going to be on the 4-hour. We have a very similar situation. We have a no-wick candle in here, which I have previously told you, which we like to trade into. What else do we have? All of these highs basically are going to be what? Relative equal highs. That is going to be your liquidity that we want to trade onto the upside. Now notice even closer on the entire time frame, we even have more imbalances that we like to trade into. Now this becomes a very great setup. Pay attention to all of this. You're having this FEG combined with the liquidity higher. If you're having these two as a combination, so the FEG, but also the relative equal highs, this becomes an A+ setup, but only if you know if we're going to go for the previous day high or for the previous day low. In this case, we know that we're going to go for the high. So from here on, we're going to drop down onto the 1-hour time frame. What can we spot in here? We already have tons of different reasons on why to take a trade, but you always have to look out for the opposite direction. Don't only just look out for reasons on why you should take a trade, be also prepared for the reasons why the trade should not work out. But first of all, we have another thing. We have even more liquidity residing in here. Notice how once you have identified if we're going for the previous day high or previous day low, in this case it's the high, everything aligns perfectly with each other. You have the internal relative equal highs, so basically these are going to be the internal ones. You have the external liquidity, the FEG. Everything is aligning perfectly, but there's also something that is speaking against the trade. First things first, we have this imbalance. Imbalances once again like to be traded back into. What else do we have? If you're going to measure this low and also this high, you're going to draw a Fibonacci from bottom to the top. We have now traded into the equilibrium. Now this is basically the dilemma where a lot of guys are going to mess this up because they believe that every single trade setup has to look perfect. It will never look like this again onto a time frame, never again. So this is where you have to weight the confluence. If we're going to go real quick to the daily time frame, we are looking bullish. If the high time frame is aligning to the upside, then everything that happens on the lower time frames doesn't really matter. So from here, we are going to take the position. Notice how I'm taking the position at 0 AM UTC standard time. We are going to aim for a 50 pip stop loss. Usually, I like to go for a fixed 50 pip stop loss. However, due to a lot of entry refinements and a lot of backtesting sessions that I've done, it is safe to say that you can put your entire stop loss at a nearby low in that case. Because let's just say the original stop loss is going to be in here, which is going to be 50 pips. Price is not going to magically just reverse after it has gone in here. So for this low basically, and then from that point, it is just going to go higher. It's not going to happen. If price goes all the way lower in here for this low basically, then price is also going to continue and it might as well just go for previous liquidity such as these relative equal lows. So now that we know how to put the stop loss in, we are going to adjust the take profit, which is mostly going to reside at 10 pips. Now same scenario in here. If the entire trade, so the previous day high, is in here, then you can also extend your entire take profit higher. That's okay to do. In that case, our take profit is overextending the previous day high, so we're just going to leave it at 10 pips. This is basically the rule of the take profit and stop loss placement. If there is no logic level, put the take profit at 10 and the stop loss at 50. So from here, you are going to take a trade. You always want to risk 3% on every single trade. The reason for that is because the win rate is just so high. Now quickly, before I was managing 1 million in prop firm funding, I have blown countless of challenges. And no, I am not going to pitch you my mentorship, but I am going to ask you if you want your prop firm challenge to be passed, because I am going to pass it for you. I know how it works. I have done it multiple different times with certificates, everything that you want. It is all in my arsenal. If you're interested in that, it's a second link in the description. Now, not every single trade will of course be looking like this. You'll also go into a drawdown. We have already prepared ourselves for this entire FEG, and only then we can expect to go onto the upside. Sometimes you'll get lucky, sometimes you will get into a drawdown. It's normal. So that was a take profit hit. Now we are going to go onto the daily time frame again, going to remove everything, and we're going to skip onto the next candle open. So this one is a very interesting case study. Notice how we have traded this entire candle right in here, and we have gone for the high actually, right? And we have also not traded into the gap. So you might be saying, well, the bias was wrong. No, it wasn't, because since our take profit is just so fixed, it's either going to be a 10 pip take profit or to the previous day high, you will almost always be taken out in a take profit if you're going to do it this way. So you don't have to be right on the entire day, you only have to be right on that specific move. That's all I want you to focus on. So in here, are we going for the previous day low or are we going for the previous day high? Probably we are going to go for the previous day low, not for the previous day high, because we are already so close onto it. Notice how this is going to be your first clue that we are starting to go lower. This entire price action here, so all of this was just a liquidity grab. This was the reason why we pushed higher to begin with, but we have also not traded into a random level. We traded into an FEG. Now's the time to go lower. Now I know you might be saying you're talking a lot, but this is very important. This is key information that I'm about to give you here. Notice how we have not traded into this price gap. I've previously told to you we need to trade into it with a body closure, and only from that point on we start to not care about this price gap anymore. The thing is, if the bias aligns and if you're already trading onto the downside, why would this entire gap matter? It is very far away. Things that are too far away onto the chart, such as this FEG in here, they don't matter anymore. Why would you care about that? So we are going to trade onto the previous day low. So now we're going to drop down onto the 4-hour time frame. First things first, we have this entire FEG. We have traded into it, but I've also previously told you, if you're going to have a large FEG like this, it's going to be a large imbalance, which also means the trade is going to run into that entire imbalance at some point or the other. Now chances are it is not going to refill the entire FEG at its high until it's fully rebalanced, but you can expect at least a deep pullback until you're going to go for previous liquidity. So this is the reason, even though the bias is going to go into the downside, which we are not going to take the trade. Simple as that. But don't worry, now I'm going to show you an example where it's going to be a trade. We didn't want to trade this entire day. We're going to skip it, and this is going to be the next daily open. This is going to be a different scenario. We are trading onto the previous day low, not for the previous day high. Let's drop down to the 4-hour time frame, and here's a little bit of a different scenario. I've just told you, if the things are looking very far away and they don't matter anymore, we have already traded into this FEG. Yes, this is a lot of inefficiencies in the market, but we really only need a little bit of price action to trade lower, because this is going to be our entire stop loss. This is going to be our entire take profit. We don't really need much movement. So from here, we are going to go on to the 1-hour time frame, and perhaps you already spotted it on the 4-hour. We had this entire price action gap, which we have not traded into yet, which is further suggesting we need to trade onto the downside. Before we are going to go for all of that liquidity higher, we need to go and fill out this entire price action gap. See it as that. Price action gaps have a higher priority than your regular FEGs, because that is the real inefficiency where there was actually no liquidity left in the price. We're going to take the position onto the downside. Our take profit is going to be 10, stop loss 50. If there is something nearby, then we can base it off of that, such as in here. Take profit, there's nothing nearby. And don't even get me started on that. Why are we not just putting our entire take profit to this low? Because that is just way too far away. You're overextending your take profit by double the amount basically. So you're just going to leave it as that. and let the trade run. This was another take profit hit, and oftentimes you're just going to get wigged out like that, and from here the price is going to reverse. So don't be greedy and don't try to put your entire take profit to the previous day low if it is just way too far away. So here are the backtesting results of the entire strategy. Notice how I'm not just backtesting for 1 month like your usual guru, I am backtesting this for multiple years. This is just one of my backtests. On my Discord and also in my mentorship, there's going to be the full explanation and also the full journal which you can look into with screenshots, with every single confirmation. Basically every single trade that I have taken has been documented in there. But no pressure, you don't have to take the shortcut. You can also just put in the work by watching this video. It's going to explain to you everything from A to Z on how to do this on a day-to-day basis. Every question that this video might brought up, this video is going to answer it. So thank you guys for watching. Make sure to like the video, subscribe to the channel and comment down below. See you in the next one.